This is the third in the series from Notion Capital on the 1 to 100 million revenue journey. In the first in the series, which you can find a link to in the comments below and on the Notion website, we talked really about the big picture of dove into the data underpinning this story. You can find that on the website. In the second, we took the 1 to 100 million revenue journey, and we broke it down into start, build, and scale in a little bit more detail. And we talked about the fundamental principles, what underpins these three very distinct stages. In this one, we're going to be talking about mistakes. And I think this is a really interesting area to dive into. We spend so much time, don't we, thinking about what we should do, but there are very important strategic decisions of what we don't do. There's a big shout out here to Doug Kellogg, who's an entrepreneur in residence at Borderton. He did a fantastic presentation. You can find on the Borderton website, I think probably about six months ago or so, which detailed the 5 biggest mistakes from 10 to 100 million revenue. And I found that really fascinating and thought-provoking. What we wanted to do is to take it down a level, because we believe the fundamentals of the 1 to 100 million revenue journey really exist in 3 distinct operational phases. It's almost like running 3 different businesses. In the start phase, we're trying to figure out, is there a problem worth solving? In the build phase, we're trying to figure out how to solve that problem and sell to that problem repeatedly and consistently. And in the scale phase, we're trying to get as big as we possibly can because we've learned how everything works. And those stages are really different. And so the mistakes that people make at those stages are quite different as well. And so that's the topic we're going to be digging into. And I think it's quite interesting to overlay this with kind of some of the insights in terms of the probability of success in SaaS. I covered this in a lot more detail in the previous presentations. We did some cohort analysis on 120,000 SaaS companies going back almost 20 years. We looked at how many of them were VC-backed, how many of them raised capital, and then how many of those turned into 100 million revenue businesses or $1 billion plus exits and IPOs. And the numbers that you can see there is about 1.8%. And so we believe there's common principles that underpin success of the 1.8%, but there's common mistakes that some of those companies make and that many of the others make as well. Excuse me, got a bit of hiccups. And what's even more interesting is below that 1.8%, so the 243 companies, there are actually only 168 out of that cohort. That's just over 1%. That's like 1 in 100 of that cohort that within the time period of the analysis we've looked at have achieved 100 million in revenue. Now, there's some companies later in that cohort who will still go on to achieve 100 million in revenue. I realize that, but this is a pretty extensive data set. And what's really interesting to me, though, is just how quick, on average, companies do achieve 100 million in revenue. 20% of the centaurs in this list achieved 100 million in less than 6 years. Median is actually 9 years, and the majority reach 100 million in less than 10 years. And I think that's a really, really important point that we need to always bear in mind. And apologies if you listened to the previous 2, you'll have heard me say the same thing, is that what it appears to us is that if companies do not achieve 100 million in revenue in less than 10 years, it becomes less likely, not more. And lots of really thought-provoking reasons that could be technical debt, organizational debt, could be founder fatigue, investor fatigue. It could be obviously the timelines of the investors, such as ourselves, working within a 10-year fund, but also technological obsolescence, right? And competitive pressure. And if you haven't created the market power to become an enduring business, pushing well past 100 million, it becomes less likely, not more. I touched on this a little bit at the beginning. Start, build, and scale. We dramatically oversimplify this because I think contextually it's really important for people to understand, where am I? Am I starting? and employing starters? Am I building and employing builders? Am I scaling and employing scalers? And we differentiate between product market fit, go-to-market fit, and scale to market fit, or perhaps, as I sometimes like to think of it, multi-market, multi-product, multi-everything fit. And people think of this startup journey as being some kind of continuum. It isn't. These stages are very, very different. When we overlay those stages onto the fact that maximum 1 in 50 companies on aggregate achieve 100 million revenue or the $1 billion IPO, is that 40% of companies that raise a Series A never get past 3 million in ARR. 20% never get past 1. 60% never get past 10. 80% never get past 30. So 20% get past 30 million ARR, but of that, maximum 10 to 15%, 2 to 3% of those companies get to 100 million plus. And that's not altogether surprising, I think. And at the early stage, the failures are often, we're really not solving an important enough problem. But if we can get to 3 to 10 million within a reasonable order of time, then we think a lot of the reasons for failure are avoidable mistakes. And we'll be talking to those in a little bit more detail. So start, build, scale. It's simple, but it's not simplistic. So it's designed to cut through the noise, and it's designed to allow us to think about the fundamental challenges we're facing in a very straightforward and profound way. And we believe that what's critical to success is having the contextual understanding of where you are in this journey. Are you start, build, or scale? And when and how to transition from one to the next. And when I was doing the research for this, this work, I talked to a lot of other VCs, and Doug Landis, who's growth partner at Emergence Capital, it's quite interesting because he talks about it from the perspective of not just the pressure founders put on themselves, but obviously the pressure that VCs put on founders. We put a lot of focus on helping companies pushing companies to grow. And the reality of the changes as you go from 3 million to 9 million, for example, is obviously a 3x increase in pipeline. Now, while that might seem fairly straightforward, of course, if we haven't developed the consistency in terms of how we build pipeline and how we convert it, then that can be very problematic. And as Doug points out, that leads to the first of many revenue misses. But if a company can figure out how to navigate these early murky waters and hit those targets, they set themselves up for another difficult hurdle, getting past 30 million in revenue, entering new markets, new geographies, launching new products. So that contextual importance is critical. A couple of things to draw out, which is that certain aspects, I think, hold true throughout. When we think about how we grow, the people we hire and fire, and the value we give and get, focus is paramount. I'm just going to pick one of each of these topics. The people who thrive at each stage are often very different. And we constantly got to be focusing on driving consumption of the value that we deliver. Again, there's a lot more detail on these topics in the previous sessions. So we're going to get into the mistakes section. I think one of the things that's really interesting about mistakes is that if we think about this on a personal level, we all know the things that are bad for us, and that if we avoided them, our life would be better. That doesn't mean that that's easy to do, right? Because the mistakes we know we make can be quite appealing and beguiling. And I think the same is true in business. There are certain mistakes that we see founders and companies make, which are entirely understandable because of a desire to achieve a certain outcome. And so it makes it very difficult to avoid them. Just before we jump into the start phase mistakes, probably important to think about the start phase. We really talk about it in terms of finding product market fit. We break that into two areas. One, pure discovery. And secondly, if I've got the inkling of product market fit, can I start to go beyond the founder-led sales? And that's a topic we'll be coming back to over and over again. In the next session, I'm going to dig into that a lot more detail. So mistakes to avoid that are specific to the start phase. The first of them, I think, is probably the most common, which is burning money trying to grow before you're ready. And until you've got that deep understanding of who your ideal customer is and why and how they buy and how to deliver value to that organization, you need to resist that temptation to invest in commercial resources. Resist the pressure from the VC to say you need to grow faster. You need to understand when you can move from being very, very constrained in terms of your deployment of go-to-market resources to unconstrained. And the start phase is not the time to do that. Because that's the first mistake we see. The second, I think, is to a certain extent ties into the first, which is outsourcing product market fit to sales. The key thing about the founder is that they've invested in a deep understanding of the problem and the market and the solution. And their role is fundamental in terms of that early sales process. And critically, feeding into how do people buy and how do we sell so it can become increasingly predictable. If you make the mistake of outsourcing, finding product market fit to sales, you have abdicated, I think, the single most important responsibility that a founder has at this stage that helps me to answer this one question. Is this problem worth putting my life on the line for to build a massive company? And can we deliver the value needed to address this massive market? The third is about acquiring non-ICP customers. This isn't just a start phase problem. This is a forever problem, but it starts here because the customers you choose in the start phase will dictate to a very great extent the destiny of your business. And so winning that non-ideal customer, too big, too small, who then simply churns, is one of the surest ways to bake in failure into the start phase. To be honest, this issue doesn't go away. Acquiring non-ICP customers is always a problem. And I think the most important question we should always be asking ourselves is, do we know who our very, very best customers are? And a way engineering to support and serve those customers in a way that delivers huge amounts of competitive advantage and value. It's classic Michael Porter kind of thinking. We're designing competitive strategies all about winning customers that we choose to serve uniquely well. Number 4, being the sales hero. Every deal a minor miracle. Again, these things all intertwine. So that extraordinary founder at the front end of the business, they know the problem, they know the market, they know the solution inside out, so they can pull it out of the bag over and over and over again. But that is not a way to kind of scale a business. You have to be taking strides to not only sell, but learn how to sell. To not only see how customers buy, but understand how they buy, so that this can become much more formulaic. And the last one, this is a real, I think, a bit of a bugbear of mine, kind of inspired by my good friend Dan Steinman from Gainsight. And he puts it like this, is that one of the biggest problems in SaaS is that people think that it's all about selling. Selling in SaaS is 5% of the job. 95% of the job is making the ideal customers that I've won insanely successful. All the profit and all the value particularly in a sales-less motion or a product-led motion, all of the value is in years, not even year 1, year 2, 3, 4, and 5. So we need to make sure that we're investing as early as possible in customer success. So a few key takeaways. Number 1, from 0 to 1, the founder's primary role is finding product market fit to a reasonable degree of certainty. I'm going to talk a little bit more, again, and go into more detail in this in the next sessions. From 1 to 3, the founder's role is to establish the foundation of the go-to-market and a highly transferable process. Those are, again, 2 different phases within one stage. Key takeaways. Never lose sight of this, repeating what I said before. Is this idea worth putting my life on the line for the next 10 years, maybe 15 years, maybe 20 years to build a massive, massive company? I think everything starts from that problem. Is that problem sufficient to turn into a purpose and a mission that will allow me to attract the best customers, the best employees, the best investors to build a huge company? Second key takeaway, establishing product market fit is the founder's job, nobody else's. Number 3 is stay lean and stay mean until you've established product market fit. Even going into go-to-market fit, which is the next stage, you still need to maintain that ethos. Number 4, invest in customer success early. It was Jason Lemkin who said that customer success should be one of your first 10 hires. He is entirely right. As soon as you're starting to win clients, you need to be thinking about how you're going to make them successful. Now, the characteristics of the customer success people you're going to hire are going to be different at the early stage than they would be at build or scale. They might be more of a combination of success and product. They may be more generalist than specialist. They may come from a very different kind of background, but they've got to understand, how do I take that great customer that we've won and deliver on the promise and make them successful? And then lastly, as the founder, you probably are the best salesperson. You probably will be for a very long time. Maybe for that full 10 years, I might want you, the CEO, talking very, very early to the very best opportunities, but you have to make yourself redundant from that process. So let's talk about finding go-to-market fit. This, again, 1 stage, 2 phases. The first of these is something that I think is really kind of under-intellectualized a little bit, which is like, actually, how do we go about designing the go-to-market model? And I'll touch on a few things, but I'm not really going to do this enough justice in this phase. But we'll come back to this in more detail. Then once I've established the go-to-market model, say I'm getting to like 10 million ARR plus, then I've really got to be driving consistency and predictability in terms of my execution of my growth strategy. So 1 stage, 2 phases. So biggest mistake. This is a bit of a shout out to Frank Slootman in his book, Amp It Up, and also in a podcast I listened to. If I can find it, I'll drop a link into that as well. And he talks about the fact that the playbook reflex is one of the worst reflexes that any founder or CEO or executive can have. And what he means by that is assuming that a go-to-market model that worked for company A and maybe company B will work for you. It might, but it probably wouldn't. It's critical to understand history, to understand the context of today, and I think that's important for many different walks of life, right? Not just for businesses. So we need to understand how all these go-to-market motions work. But we also need to understand, hey, who's my customer and how do they buy? Is the economic buyer the user? What's the size of the market TAM? What is the typical dynamic for buying in this industry for the type of problem I'm solving? Is it a known problem or an unknown problem? Am I selling a land and expand, or am I selling enterprise? Assuming that what worked for another company and then hiring executives who think that way is a mistake we see over and over. A second one is, let's assume that we do start to find a go-to-market fit. Is we assume that product market fit in one segment implies product market fit in another. We would argue that in every instance, you always need to be thinking about the sellability of a product in a segment and the buyability of a product in a segment. Think of that as like two dimensions, with value as another, as a third dimension. And for every time we're selling to a segment where we've got product market fit and we're thinking of another segment, we should not assume that the way we operate in the first segment will in the second. The third, and this kind of ties into the first one, is diluted go-to-market, spread thin and unfocused. We say you need to be uncomfortably narrow. But I suppose I'd ask myself this, like, if I've identified who my best customers are, they buy the most, they buy the fastest, they get the best value, and they generate the best advocacy, wouldn't I want all of my resources focused on targeting that segment? I don't understand why I wouldn't do that. That makes complete sense. And so being very, very focused in go-to-market and building momentum, this is a big shout out, of course, to Crossing the Chasm and all the seminal work that Geoffrey Moore did there. So be focused and be uncomfortably narrow. Tying into the first mistake in terms of the start phase, which was investing in go-to-market before you're ready. We're now starting, we've got a bit of a duality here. So one is, a big mistake is still investing for growth before you're ready. So can we incrementally figure out who the best customers are, what the best model is, the pricing model, the go-to-market model? Can I figure out the characteristics of the ideal sales playbook, if you like? Sorry, I use that word. It becomes relevant when you figure it out for yourself. But at a certain point, you have to become more and more comfortable with being unconstrained in terms of your resource. Like, everything is looking green. I've got solid lead and lag indicators on every aspect of the demand life cycle. All of my reps, if I'm selling sales-led, are all at or around quota. Then maybe I just want to add another rep and add another rep. And so finding that balance, I think, is absolutely critical. And then the last one, and this doesn't just apply to go-to-market, it applies to every aspect of the business, but I think it's most acute in probably marketing, sales, and success, possibly also in the people roles and maybe in product as well, which is assuming that the leaders who made you successful in the start phase will make you successful in the next. We believe there's a fundamental difference between the characteristics of people who can be 9s and 10s out of 10s in the start phase, and those who can be 9s and 10s out of 10s in the build phase, and similarly true in the scale phase as well. And so to avoid number 5, you have to think about the fundamental requirements of the stage you're in, the types of people you need. And the people you need in the build phase, if they're generalists in the first start, they're specialists in the second phase. So some key takeaways. 3 to 10 million. Establish your go-to-market model from first principles. 10 to 30, build your playbook and execute with increasing levels of repeatability, predictability, and actually consistency. 5 things to take away. 1, know your best customers and execute relentlessly against them. Just like I was saying in terms of the mistake of winning non-ideal customers was true all the way through. This is true all the way through the cycle as well. Secondly, and this kind of ties into, if I know who my best customers are, don't I want all my resources focused on them? Well, yes, but if I've got 4 or 5 segments, maybe I want to think about which one am I going to do next? Which one am I going to do third? Which am I going to do fourth? And understanding that prioritization is critical, but executing against them sequentially is paramount importance to build momentum. I think the same is true for product work and project work as well. Focus on the most important segments, projects and products first, and build momentum from there. Third one is that first principle to go to market, build a growth engine that's as unique as you are. It's as unique as the problem you solve. It's as unique as the value you create for your customers. The single most important thing in terms of achieving scale is the commercialization strategy. How you're going to connect your value to your target customers. And that has to be proprietary to you if you're going to have real power. Fourth, invest in repeatability and enablement across the life cycle. So when we talked about the importance in the start phase of the founder making themselves redundant, this is about building redundancy in right the way across the cycle. So that we can underpin everything we do at the build phase with real great kind of levels of sophistication and data and insights to support people to do their job really well. And then lastly, use lead and lag data across the demand, sales and success life cycle to drive growth. Now we're going to be focusing on more on this in the coming up session, so I apologize, there's a bit of a quick rattle through. So now we're into the scale phase. Scale stage, 1 stage, 2 phases, 30 to 100 million and 100 to 300 million. Now, I'm not going to get into the 100 to 300 million, kind of a post-IPO stage, if you like. Whether we are listing the company or whether we are going independent, or we're going to be recapitalizing, or we're going to be selling to private equity, the fundamentals post 100 million are we building a business that will really endure? But we're going to focus on the 30 to 100, and it's really about optimizing and maximizing efficient growth. So a few things to call out here. Number one is, I think this restlessness of we can always do better. The fact that if we've been successful, it may be despite ourselves, not because of ourselves. And also, as I've got here, number one, that what made me successful last year may not make me successful next year. So we've always got to be challenging ourselves to be really thinking about what leads to success. We'll touch on that a little bit more in a second. The second is kind of running out of road. So do we need to, as my friend Chris Topman says, stack the TAM by adding new products, by acquiring new markets, entering new markets, by maybe acquiring new products. We need to increase the value of the proposition we're offering to be able to increase the size of the market we're targeting. So be very wary about the fact that actually, is the market big enough without anything else changes for me to achieve the kind of success I need? Number three is failing to productize onboarding, and in particular professional services, especially in the enterprise space. This, I think, goes back to my first point in terms of the first couple of slides. Selling is 5% of the job. We have to nail the ability to make customers increasingly successful, increasingly quickly, systematically, whether it's a product-led onboarding or whether it's a services-led onboarding. Those things need to be productized. And number four, this is a bit of a shout out again to Doug Kellogg. It's something that he talked about extensively in his presentation, which is about the requirements of addressing the burgeoning technology debt. And I talked about the slowing down of companies after 10 years. And arguably a big part of that could well be technological debt, which is just slowing an organization down. So you need to take the steps to address that as you get into the scale phase in particular. Another mistake, and this is a people-related one, every member of the senior management team in the biggest jobs of their lives. There probably will be some people who are part of the founding team who took you through the start phase and took you through the build phase. But again, when we get to 30, 40, 50, 100 million, multi-level teams, managers managing managers, the requirements of the senior management team is absolutely to be leaders of leaders. And if every senior member of the senior management team is in the biggest jobs of their lives, then you've probably got a challenge. And then the last one here, I'm going to touch on this a little bit more, is kind of falling for the myth of growth degradation. This was some very interesting research that Bessemer pulled out, and they pulled a group of, I think it's about 100 companies, and they looked at last year's growth and current year's growth. And they plotted all that on a graph and drew a correlation line, which is 0.7x. And therefore, from that, postulated that growth degrades by 30% year on year. And this is quite a well accepted kind of concept. And I think it's really quite, I can't think of the word, pernicious, a little bit dangerous, very misleading, because actually when you look at this data, you can see there's some companies that last year grew very fast and this year are growing very slowly. And this year we're growing very fast and last year we're growing very slowly. And when you actually take a step back and you look at this, you say, well, actually, there's not a lot of correlation in this chart. There is almost zero relationship. And so while in aggregate, of course, the average says that companies degrade by 30%, but lots degrade by a lot more and lots grow by a lot faster. So a couple of takeaways, obviously forecasting growth for early stage cloud companies is really hard. But going back to what I was saying before, the actions that drove growth one year don't necessarily drive growth next year, good or bad. And good growth outcomes can go from one to the other. So one, don't accept that that is inevitable. Rail against the fact that because you grew 100% this year and you're 30 million ARR to get to 30 million, then next year is going to be 70%. And the year after that will be 50%. And the year after that will be 40%. Doesn't have to be that way. Understand the limits of growth and ensure that you're putting in place the success factors to allow you to grow as fast as your market will allow. Some key takeaways in the scale phase. One, still know your best customers and execute relentlessly against them. Again, doesn't change. Two is understand the size of your TAM, understand the segments that you're targeting, but consciously start to expand your value and your TAM organically and inorganically. One, invest in world-class tech processes and bring in true executives to run the functions. The type of CFO you need to take you to and through 100 million in revenue is going to be very different from the type of CFO that you hired when you were at 10 million of ARR. You need someone who can understand how to use data to allow you to run the business incredibly well. You need to have somebody there who knows how to forecast effectively or how to hit targets or whatever it might be, whether who's leading the sales team. You need a marketing person who is able to think about the fundamental requirements of leading big functions with massive budgets. Technology, people, processes really coming together to really run those functions. The CEO's role becomes ever more customer-centric and strategic. So are they working, looking out and seeing where the opportunities are? They're trusting the business to organize individuals who are leading those individual functions. And then number 5, lay the groundwork for enterprise value realization. As you get towards 100 million of ARR of revenue, there's a really strong correlation with that and enterprise value. But in order to maximize enterprise value, whether that's being acquired by private equity or whether it's being acquired by a strategic, or whether it's entirely recapitalizing or whether it's a public listing, takes conscious effort and intention. And that work starts arguably potentially early in the scale phase, but it absolutely has to kick in the scale phase. So just wrapping it up, in summary, start, build, scale. Fundamental principles that underpin each of those and fundamental mistakes that people make along the way. The most important thing is to have the contextual understanding of the stage you're at and your readiness to move from one to the other. And your role as the founder, as the CEO, is entirely contextual related to that stage. Second is focus on the first principles that underpin success. What are the core things I need to do to ensure that I'm solving a problem that's worth solving? What are the critical things I need to do to understand how to solve that problem repeatedly, consistently? And what are the core things I need to do to be able to ensure that we grow as fast as we possibly can? Limit your options to focus and narrow your focus. So being sequential in your mindset, eradicating mistakes everybody makes. You have to leave room for your own mistakes because we're in the business of taking risks, right? But don't make the mistakes everybody makes. Winning the non-ideal customer, executing in parallel, not sequential. Or in the last one here, putting the wrong people in the wrong jobs. No, put the right people in the right jobs. With both the attitude and the aptitude and the pedigree and the desire to be a 9 or 10 out of 10 in the start phase, build phase, or scale phase. Are they starters, builders, or scalers at heart? There are people who can do all three, but they will undoubtedly have a preference. And I think if you can put people into their sweet spot, where they feel most comfortable, then they and you will be most successful. Thank you very much. Hopefully that was useful to, if you want to learn more about the kind of work we're doing, you can find that on notion.vc. In the next session, I'm going to be doing a deep dive and a much more extensive analysis of the start phase and what it takes to find product market fit. That's been talked about a lot, but how to transition that into and beyond founder-led sales. And then after that, we'll be going into the build phase in more detail. So thank you and look forward to seeing you on the next session.